Now we're going to talk about a short seller, why he's short the market, and we're also going to talk about what's going on with consumer savings, consumer spending, and which companies could actually win bigly. I think this is going to be one, not only you want to watch in full, but you're going to want to pay attention to the companies I mentioned at the end of this, because they're not my traditional companies that I talk about. But let's first listen to why this guy, Jim, is shorting the market. Hedge fund dude coming to you out of Miami in an interview with CNBC. Let's listen in. What does he have to say?
Let's bring in famed short seller. This is our headliner for this evening. Jim Chanos, founder of Chanos and Company. Jim, it's a pleasure to have you with us. Thanks so much for joining us.
Welcome to my hood.
I know, your new hood, or not relatively new.
Been down here 20 years.
20 years. I didn't realize that long.
Yeah.
What do you make of this memo, this notion that we could be at war with China? It feels like people don't want to believe it or don't believe it.
Yeah, I mean, the war in the Pacific is serious stuff. I mean, let's not forget we have a land war in Europe going on right now. I mean, sort of a World War II, tanks, artillery, things we haven't really seen in our lifetimes. And so a shooting war in the Pacific, all bets are off. I mean, I certainly hope that doesn't happen. And but yeah, I mean, it upsets everything because of what Guy said. I mean, whether it's supply chains, whatever. I mean, having China go to war with the West would be just apocalyptic.
How does that factor in, if at all, to your view on China and how you view that market in terms of opportunities for you?
Yeah. Well, obviously, our view on China, which is now 12 years old, I mean, has been based on the financial system and the debt and real estate markets over there. And not a whole lot changes. Obviously, China will become more insular. I've been watching the China reopening trade like everybody else has for the last 6 or 9 months, and sort of marveling at it. But I don't think there's any way to handicap it from my perspective as a hedge fund manager. I mean, again, if it happens, the unintended consequences will be severe.
Okay, so a little bit of a warning about maybe war with China, but let's be real. I don't even think he expects that tail risk is going to happen. So let's get into why maybe a little bit more he's actually short.
Jim, do you think though, going forward, we're just seeing, the situation with Russia and Ukraine was simple. U.S. multinationals had to take a stand about the Russian aggression. It's a little different with China. When you think about our reliance from a manufacturing standpoint, our U.S. multinationals' interest in that emerging middle class, which has been a part of the bull case for 20 years now in China. How would that play out? Because I really feel like that could change the dynamic for a lot of U.S. companies.
Yeah, I mean, I think that we're far more intertwined into the Asian economies, in particular China. And so
I want to mention here, holy smokes, the amount of investments Starbucks is making into China, insane. I just went through the Starbucks earnings call, and I'll probably do a separate video on it, but it's worth mentioning that in 2018, Starbucks had 3,521 stores in China. By 2022, they added almost all of the stores that they added. 97% of the stores China, or that Starbucks added in the world went to China. 97% of them, another 1,737 stores. And they're now at about 6,000 stores here in Q1, 6,100, I believe. Yeah, 6,100 Q1 2023. Q3 2022, they were at about 53, 58. And they expect to get to 9,000 stores in China by 2025. Now, what's remarkable about that growth is Starbucks is really telling you, and they're screaming at you, we think that they're going to make it. They're going to make big profits, big tendies in China. Let's keep going. We'll see.
Anything that would end that and bring it into a Cold War, much less a shooting war, I mean, just has to be just a major event for not only markets but geopolitics. I mean, it's scary stuff.
Jim, we talked about multiples of this market, expensive, not expensive. I mean, 30,000 feet. What are your thoughts? I mean, again, that don't fight the Fed mantra that's been out there. For some reason, people want to look past it when it doesn't sort of line up with the market going higher for them.
Well, I think we don't try to time the market, but like anybody else, I have opinions, and things are not cheap. I mean, they're not as expensive as they were say a year and a half ago. On the other hand, the market is at 18 times forward. Profit margins are at all-time highs, so that has not mean reverted. And one of the most mean reverting time series in all of economics and finance is corporate profitability. And it's been stubbornly good and high. But since I've been on the street in 1980, not one bear market has ever traded above 9 to 14 times the previous peak earnings. So whether it's 87, 89, 90, 94.
I just want to take a quick pause there and mention what he's saying is that we are at such a high level of essentially our multiples now on the S&P 500, our price to earnings multiple, right? We're willing to pay 19 times S&P projected earnings for the S&P right now. And Jim is suggesting we've got to get to probably 9 to 14 because historically that's where S&P 500 earnings go. Now, I actually do not disagree with this. It is one of the reasons that I really believe you have to invest in individual companies versus just the S&P 500 over at least the next year to two. Because I think S&P 500 companies are going to get reamed with earnings, many of them, whereas individual companies that you can select might end up showing and proving more pricing power through this sort of recessionary dynamic, and you might actually see a lot more earnings growth. Now, no guarantees, okay? It's not personalized financial advice for you, but that is at least something that I think individuals would have to consider. Let's keep going.
For 2002 or 09, if you think earnings are peaking now, at $200, that's a long way down, right? That's $1,800 to $2,800. We're not anywhere near that, and so you have to hope earnings hold up, and you have to hope. I mean, look, right now the market in the space of really 6-7 months has gone to corporate profits are going to be up 12% this year. Inflation's coming down to 2%. The Fed may be easing at the end of the year. I mean, that's pretty much nirvana if you're a bull.
He's basically here saying, hey, look, the market's pricing in great things, corporate earnings up, whatever. He's making the bet against the SPY, basically.
That's what markets actually forward pricing think right now. They're wrong all the time, but people are pricing in a pretty nice Goldilocks scenario.
Are you trading the markets directionally overall, or is it just individual?
No, I mean, in our hedge fund, we are slightly net short, slightly net long, and so until recently we were actually slightly net long. I think we've gone to back down to zero line, plus or minus. And in our short-only funds, we're 60 to 80%. And so it just depends on the individual names in those. And we try not to take a lot of systematic market risk in our hedge fund.
A lot changes, though, when you go from 0% interest rates to what could be 5%. It
Yeah.
can certainly accelerate the fundamental stories you bet against when you do your deep fundamental analysis. So I'm wondering, are there positions you think look even better now because that environment changes? Maybe the debt service is too heavy a burden, et cetera?
Well, one of the areas I'm marveling that has held up as well as it has, with a couple of exceptions in subsectors like office, has been commercial real estate. I just don't get people buying almost any kind of commercial real estate that doesn't see good demand at this point.
First of all, hands down, 100% correct. The fact that these real estate funds are getting massive outflows right now totally makes sense to me. Like, why would you buy real estate and get 5% cash flow when you could just invest in Robinhood and get 4.15%? Like, it doesn't make sense. And this is exactly why we see this as, first of all, we see a big compression coming in valuation for real estate, which is exactly what we're preparing for with my real estate startup House Hack. The whole point of House Hack is to wait for the pain and then get in, right? And then we've got some really phenomenal ideas in terms of maximizing cash flow and being able to sort of cycle wedge deals over and over and over again, which we're really excited about. And obviously, we're working to bring to non-accredited investors as well. If you're accredited, you have a big advantage by going to househack.com, reading the solicitation there, and potentially investing before the end of February or the end of March, because you get some more bonuses for future potential warrants, which are somewhat kind of like call options that you get for free. They're different. Read the website, you'll learn more about it. But anyway, totally agree right now that real estate, especially some of the REITs, really expensive, especially commercial, like office REIT. We just had a New York developer start giving stuff back to the bank. And I hate it when people say that, because it basically just means you sucked and you had to turn around and give up and admit an L. But this New York developer's like, yeah, I'm giving properties back to the bank. I'm just handing the keys back to the bank. And I'm like, it doesn't really work that way. Like, you're getting foreclosed on is what it is. It's disappointing. But anyway, let's listen in here more to the short seller, and then we'll add some commentary about U.S. consumers, their spending, and where we might be going with consumer debt.
3%, 4%, 5% so-called cap rates. It makes no sense. SL Green, which we are short, New York offices, been short now for a couple of years, trades at a 5% cap rate, and it's levered massively to its cash flow. And I just don't want to buy New York office buildings right now at a 5% cap when the balance sheet is leveraged 15 to 1. It just makes, and there's all kinds of stories like this out there in the commercial real estate. As you know, we're short the data centers, which I think is one of the worst businesses I've ever seen. They trade at 100 times earnings. And earnings are the metric because CapEx equals depreciation.
He's not wrong. Some of the data center REITs trade very, very, very expensively. I personally prefer investing in the chips. I don't know. I feel like chips themselves are like the pickaxe, the backbone of it all.
And so there's just all sorts of odd anomalies in the valuation space of things that are just in the stratosphere still that sort of make no sense to us.
Yeah, sometimes things look cheap and they're actually more expensive than, like the Intel quarter, for example, was a disaster in that world. Debt ceiling, and politics are boring. We don't really talk about them, and I'm not suggesting we're going to go down 2011 path when U.S. debt got downgraded, but it's clear that there's a faction of people that want to push the envelope on this. Is that something that concerns you, or we just sort of slide through this like we typically do?
No, again, it's another that would be kind of another black swan that no one thinks will happen, including me. Just when push comes to shove, I think we're going to pay the interest on our debt. But who knows? Could be wrong.
All right, so there's our little CNBC interview. Now we got to talk about the consumer here, because the consumer, I think, is going to be a big piece of this, as well as markets. So first of all, is it possibly true that there's more pain to come in markets? Absolutely. In fact, here's the biggest thing reiterating Jim's point right here. This chart right here is called the yield curve. It is the 3-month 10-year, and if I hide myself for a moment, what you could do is you can compare the dot-com crash of the yield curve here to the Great Recession yield curve bottom to approximately the 2020 yield curve inversion, and then which is anything under 0, which is over here, right? So there's your 0 line, to where we sit now, which is massively inverted. And folks, look at when the yield curve hit its lowest point. It was at the beginning of 2001. You still had another year to go of hell before the markets bottom. Markets didn't actually bottom until over in this region, substantially higher when the yield curve went substantially positive again. The markets did not bottom in the Great Recession until the yield curve was substantially positive again. In fact, it went super negative at the beginning of 2017. Now, that's the remarkable part about this market, is the biggest thing that bears have going for them right now is that historically, the yield curve is suggesting the most painful part is actually still ahead. The only reason you could suggest that the most painful part is not ahead of us would be to argue that, well, wait a minute. The entire reason markets are selling down is because the Fed is trying to get rid of inflation. As long as inflation goes away and the Fed can then relax, earnings per share will continue to grow. They'll go back to growth. We'll put the pain of 2022 and the beginning of 2023 behind us, and we'll be right back to growing and booming. That's sort of the bullish idea, and it's really the basis in the argument of this time is different, which are the 4 most dangerous words in investing. This time is different, very dangerous. So that gives a lot of credence to short sellers. So we always want to be as neutral as possible on the channel. Obviously, everybody's got their biases, but the goal is to be as neutral as possible. And look, you got to give credit where credit's due. The yield curve is the most concerning part. Now, you could try to explain this away. You could say that we had structural differences between the recession of 2001, where you had basically a market that was running solely on tech valuations, which had bubbled to insane levels and has collapsed. Our market today is so much more diverse. Our economy is so much more diverse. And by having a so much more diverse economy, it doesn't really matter that certain like SPACs or whatever here recently have fallen like 90%. Our broader economy and the consumer is still strong. We'll talk about that consumer in a moment. And that potentially businesses can take this as an opportunity to invest, kind of like you're seeing Chipotle doing, you're seeing the chips companies doing, you're seeing a lot of companies throughout America saying, look, the hard part is going away. The second half of 2023 should be very strong for them. That's the argument. Will that hold true? We don't know. But we're also looking at different structural causes of a crash now than we had in 2006 and 7. In 2006 and 7, you had a real estate disaster. Dead people getting loans, people who couldn't qualify for loans getting teaser rates of negative interest rates that ended up adjusting to 7%, and then they had to go into foreclosure, so you had a foreclosure crisis. We don't actually really have a clear fundamental disaster that we could see right now. But then again, that's why they call it a black swan, because maybe we're just blind to that potential black swan. And maybe that black swan is coming, and then we could go, oh yeah, there were real fundamental problems. In which case, the inverted yield curve would be correct, that the pain is still ahead of us. And that gives credence to what short sellers like Mr. Jim are saying. Now, other folks look at what consumers are doing and say that consumers are basically building up a consumer credit bubble. In fact, CNBC just posted yesterday this particular piece here, which shows that U.S. credit card debt jumped 18.5% and hit a record. Total credit, according to TransUnion, hit a record. Annual APRs are already sitting at 20% on average, basically meaning more and more money of individuals' income is going to debt payments. You've got an average balance on credit cards of $5,800, and you're returning to levels of consumer debt in terms of a payment of their personal disposable income that resemble what we saw before the pandemic. In other words, we're getting back to levels where people are spending more potentially than they're actually able to save. And this is very easy to see by just looking at the personal savings rate. The personal savings rate was just 3.4% in December. That is a disaster compared to the usual 5 to 6% where we sit. And it's certainly a disaster relative to the COVID era, but then again, we were getting a lot of money that we could save via stimulus checks. So we are in this little consumer savings glut at the same time as people are taking on more debt. And at the same time that we're actually going back to 2019 levels of spending, debt spending as a percentage of personal disposable income. Now, the good news is, if you compare to the last recessions, the dot-com bubble and the Great Recession, or the recessions of the 80s, you actually had consumers spending, households. Households were spending over 11% of their disposable income on debt. We're at 9.7% right now, which is in line with the lower levels of about 9.7% between 2010 and 2020. Now, that 1 percentage point doesn't really seem like a difference, but between 11 and 13% is where we sat during the recessions. And if you see the chart, it's actually a substantial difference. So we've got a substantial way to go. However, this is where I think the problem could actually come. If inflation rears its head again, then you're in this really interesting environment. Because think about this for a moment. What I think you have right now is you have people borrowing, they're taking on more debt to get through the inflationary period, right? So debt now as a bridge. Think of it as a bridge, right? You're bridging to get through the painful period. So yes, consumers are taking on more debt. This is just my theory. As long as inflation goes down, then we can refinance the debt. And that debt payment as a percentage of this personal disposable income plummets again. We have to rely on being able to refinance that debt. However, if we get a second wave of inflation, this debt stays expensive. And then we potentially go back to this sort of era that we had in prior recessions where People are spending way more money on their own debt as a percentage of their disposable income. So you go back to 2006 and 2007, 2008, and 2009. You go back to a dot-com bubble, and you actually confirm what the bond curves are telling you. You confirm that the worst part is still yet to come. And then guess who ends up being right? Jim, the short seller. So if debt is not just a bridge, but it actually stays because inflation pops up again, then the bond market's inversion of the yield curve will be correct. The painful period is still to come. The earnings decline is still to come. The S&P 500 is still to fall. The short sellers will be correct. As earnings collapse, the market will go to crap. However, if inflation goes down and that fundamental reason for a crash now goes away, then guess what could end up booming? And this is what I teased earlier with which companies could win. All of this debt that's being taken on credit cards in excess of 20% right now, or personal loans that are being taken on like crazy right now, something crazy is going to happen to that debt. Let me just reiterate currently what's happening with personal loans. Look at SoFi's earnings, okay? 3 months ended December 2021, $1.6 billion in personal loans done by SoFi. 1 year later, $2.46 billion. In other words, a 50% increase in personal loans at SoFi. SoFi is taking money in deposits and they're lending it out like crazy, which means people are borrowing money like crazy. And this is reiterated by what we're seeing in the numbers. This is why SoFi beat on those earnings. They're making a lot of new loans. Not only are they making a lot of new loans, but credit card debt is skyrocketing. Consumer credit has been skyrocketing. We get new consumer credit numbers next week. So yeah, you've got a lot of crazy numbers going on in the world of debt. But what happens if indeed those inflationary numbers go down and all of that debt, what's going to happen to that debt, folks? What kind of boom are we going to have if inflation falls? Let's write it down. If inflation plummets, who wins? And what companies win that we haven't talked about yet? Refinance companies, baby. Think about it. Any lender who makes money off of making loans wins. So that's probably going to be companies like SoFi. Because think about it. The loans they have are more valuable because they're paying a higher interest rate. And if people refinance those loans, SoFi wins because you have more refinancing income and more actual processing revenue, right? And their costs go down. Who else wins probably? Think about like a Rocket Mortgage, or what about a UWM, right? United Wholesale Mortgage Company. The real estate mortgaging companies win because a lot of people have been buying homes with interest rates between 5 to 7%. Rates go back to 3%. You're going to have a huge refinancing boom. And so you're going to have some companies with massive PP, massive pricing power. If that inflation comes down, we have that refinancing boom. And then all of the debt that consumers have taken on actually doesn't become that big of a deal. You could have consumer debt as a percentage of disposable income right now, literally as high as 2007 levels. But if rates plummet and people refinance it away, that burden goes down really, really fast. Also, think about this. Autos. The entire auto sector will be a whole lot more affordable for people to go buy cars because then they can go finance cars again at 3% instead of, the 5 to 7% they're paying right now. So as long as inflation falls, consumers, what they're doing is they're borrowing through this recession. I really believe that to be true, that consumers and businesses are borrowing through this recession. I believe that's what's happening. And if the recession lasts longer, we're screwed, right? So if inflation doesn't plummet and the recession lasts longer, we're screwed. But if inflation plummets and therefore rates plummet, the refinance companies win bigly, the autos win bigly, and we don't end up having an EPS disaster at American companies. Why? Because people can keep spending. So that's a really big thesis and sort of a big conclusion there, that all of this credit spend is inflating a massive bubble. But that bubble would actually be manageable if inflation continues to go down. If inflation pops back up, we're all screwed. It's that simple. So that's why looking at the inflationary numbers is very important. Looking at the jobs report yesterday was important because it reiterated the downtrend on average hourly earnings. But it also reiterated that we could potentially dodge a recession, in that maybe we don't need a bunch of people to lose their jobs. People losing their jobs is bad for a recession, right? Best case scenario, we don't lose a bunch of jobs and inflation just goes away. Best case scenario. It's a Goldilocks scenario. And that's somewhat what markets, some markets are pricing in now, with the Fed potentially writing, basically with markets pricing that the Fed's going to cut rates eventually. So we shall see. We shall see.